Trading Safely. Thank you for joining in. It's 7:30 Sydney, Australia time. I know over in the UK, I think it's 8 a.m. in the morning. So wherever you're from, welcome, and good evening to those people in Australia. It's been a pretty interesting night tonight. Obviously, the markets have been, the equity markets in particular, have been really interesting, breaking higher. We mentioned the dollar index last week, continuing to be strong. Last week we touched on gold and how it's remaining to be weak, and we also mentioned the bond market and how the impact of the bond market's really a critical influence on global markets worldwide at the moment by virtue of the fact of the amount of capital in those markets that is now trying to find a home elsewhere. But first things first, guys, welcome. Thanks for joining us. My name's Jeremy King. First thing I'm going to do is just go through a quick disclaimer that I've got to do, just to keep my lawyers happy. So I might just put that disclaimer up, guys. It's really important information, and I insist that you just have a flick through that while we talk to you about what we're going to do tonight, because it is going to be an interesting night. We're going to have a look at, as per the email, we're going to have a look at gold. We had a few questions come in through the week about, well, what's happening with gold in the short term, what's happening with gold in the long term. Had some interesting, fundamental news from India through over the last couple of days. I think the Indian government's looking to limit the amount of gold that people can hold in India, and we all know that India is one of the largest gold holding nations on the planet. So that's going to be interesting, but we're going to have a short-term and long-term technical look at gold. We're pretty excited because Sean and I think we see opportunities in 3 or 4 markets at the moment that over the next couple of years could really be huge. So we're going to have a look at gold. We're going to have another look at the dollar index, and we're going to have a look at the Dow. That's been breaking out along with its cousins, the S&P 500 and the Nasdaq. Although I must say, the Nasdaq's obviously been lagging, but presumably that'll catch up at some stage, and will probably be the last to leave the rally in the long term. And finally, we're going to touch on 30-year bonds in the US and bond markets globally, probably more generally. And then we're just going to have a look at some of the signals that have come up for the Trading Safely subscribers through the week and what we're looking at the moment. And we've got some really exciting news. We're going to be offering some limited places with a month free trial working with Sean and I. And that's going to be a really great opportunity. But just coming back to, I'm just going to come back to a chart of the dollar index. Sean, can you see the dollar index?
Yeah, I can, yeah.
Okay. Well, just for everyone's benefit, first of all, need to give a little bit of background who we are. I mean, my name's Jeremy King. I've been a professional trader for 15 years. We've got Sean Downey on the line, who's been a professional trader for in the vicinity of, well, in the markets for at least 30 years, and very well known by virtue of the fact of his 2014 technical analysis book of the year that he wrote in 2014. He's a full-time trader now, and myself, I worked at Optiva in Australia for many years. Was in a team of 3 that made over $100 million trading. We've got lots of useful information for you guys tonight and girls, and we hope you make the most of it, and just going to be a really interesting night. So I think on that note, we might start with gold. So gold's been interesting for those of you that have been with us for the last 2-3 weeks. We kind of identified that 1200 a couple of weeks ago, that level, and it closed under that. And then the next level that we kind of raised was, well, okay, needs to see if it can hold under last year's midpoint, was around that 1180 level. And it's really interesting because this week, last Friday, we closed under last week's midpoint. So, the weakness is still apparent. But I guess one of the first things I want to address is, well, what's the difference between the short term and the long term in gold? You know, is the long term bullish, is the long term bearish? So I just want to flick over to a long term chart of gold. So this is a semi-annual, actually it's an annual chart of gold here. So we're getting the ultra long term, and what I want to do quickly here is just give you an idea of, well, what's the long term doing, just so that we're clear in the back of our minds. Even though gold seems to be selling off at the moment, we want to be clear about, well, is it going to continue to sell off, or is there some bigger trends in play? And what I'm trying to highlight here is that the angles that the market is making to give you guidance as to, you know, what the gold market's likely to do going forward. And I know, like I think it was a week or two, we were touching on the dollar index, and I was drawing some of these similar lines that that show the angle that the market can take, and in fact, you know, the angles that the market can take can last for years and years and years and years and years. And you know, in fact, this is a gold chart going back to 1976, and you know, the upward trend lines that we can see there have been in place and seem to consistently appear for a very, very long time. So when you look at these angles, it's telling you that the overall angle of the gold market is up. So whatever happens in the short term is going to be a short-term event. And if we were to look at where we, like a significant sort of close by event, it was probably this high back in the 80s. You know, we're not that far away from that now, so it would be perfectly normal to expect that, you know, potentially that the gold market could, you know, possibly drop back down to that level. So just to highlight where that level is currently, it's actually around here. So what is that level? It's around 875. Okay, so at the moment, the market's sitting around this 1180 level, and we're gonna sort of do a bit of deep diving back into the shorter term in a little bit. But I just want to show you that bigger picture. Okay, yes, all the angles on this chart are telling you that gold's going up long term, but in the short term, the downside is probably not over. So if we were to jump into like a weekly chart now, and we're going to go back into Chart IQ eventually, but for now I'm just showing you like a professional program that we use. So now, instead of a yearly chart of gold, we're now looking at a weekly chart of gold. And one of the first things that stands out to me is that we're in a down channel, and the support is a long way below. In fact, it's probably down here towards this 1040 area, 1050, 1060. And what was interesting was something I touched on a little bit earlier was, well, where's last year's midpoint? Because if you think about it, like midpoints in time are like, think of it like a boxing match. You know, in every time frame, to win, to have strength in a time frame, you've got to beat the midpoint. So, well, where's the annual midpoint at the moment? So I'm just going to add that study on now. That orange line that you're looking at now, 11,770. That's last year's midpoint. And guess what? We're trading underneath it. So that tells me straight away that the market is still weak. And potentially, looking at this now, there's a lot of room for the market to fall quite heavily. So that aside, when we come back to the Chart IQ program that we're all used to looking at, which I'm going to revert to now, I know we've got a bunch of new viewers, so once again I'm going to build up a picture of the way we model markets. So for all the new people, welcome tonight. I'm just going to build up the way we look at markets. First of all, we build long-term support and resistance. These levels are qualified, so I'm just going to add them in now. So, you know, and look, if you're interested in the program, one of the key strengths is that the program tells you where support and resistance is ahead of time, so you know automatically where critical levels are. So just bear with me while I build up our model, and I'll explain it to you along the way what we do.
I'll go long term there. You went short term.
Oh, okay, sorry. I can come back in here and change that. Okay, so these lines at the moment that we're looking at, what they are is critical levels from much higher timeframes. I'm looking at a daily chart of gold at the moment, but how can I possibly know what an important level is unless I'm looking at monthly timeframes or quarterly timeframes or yearly timeframes? And that's what the trading safety software does. We revert back to much higher timeframes, and then in whatever time frame you want to trade, then it'll pull back the important levels. And that's pretty clear here in the case of gold that we've broken through some of the major supports there, and there's big gaps below. So looks like a fairly bearish week for gold. Having said that, there might be a little bit of volatility intra-week because we've got Yellen talking and interest rates, and Yellen and gold often lead to intraday spikes, but normally the larger trend holds true. So here's our support and resistance long term. We also want to know what much higher timeframes are doing on a different front. So just bear with me while I edit the study, and then I'll explain it to you. Okay, actually I might turn the daily level on. Okay, so what we have now is the short-term blue squiggly lines are the daily time frame, and the other lines are the minimum time frame there is quarterly. Now, each of those lines there that you're looking at support and resistance levels from much higher time frames, and you'll notice right now in the case of gold we're hugging around this orange line. That's an annual level. It's actually last year's midpoint. You know, we closed under that midpoint at the end of the last week. It looks like gold's still bearish to me. Sean, what do you think about gold at the minute?
Yeah, I'm very bearish of it, I have to say. And the subscribers got involved with a bearish ETF a week or so ago. It's interesting to me that those other annual lines further down, 1061 and 1050, also coincide with the professional chart. I also remember actually, because I've been trading for 37 years, so I remember gold going to in 1980. That's what actually got me in the market when I was 16. Was gold being on the television, on the news, and it was going through the roof, and I went, wow, sounds like a great way to make money. So that's what actually got me into the market, was gold going to 800 originally. I remember the breakout when it went above 1,000, obviously a massive psychological level at the time, and it popped up, and then it came back to, I remember it distinctly, it was 10,036. And so that whole area between 10,060 and 10,035, let's say, is a major support, and I think it's a magnet. And then we see what happens there. You would assume there would be a psychological support at 1,000. If it takes that out, then I think there'd be a very swift fall, because the market would start throwing in the towel. I think you made a very good point about India. What they're doing there is pretty outrageous, really. I'm sure the people with lots of money will work out some way of getting around what they've done on gold, but they're limiting people to ridiculously low amounts of gold that they're allowed to hold in their possession. And so there's such a massive importer that it's a pretty bearish force. Obviously the dollar, we're bullish on the dollar, which is negative for gold in dollar terms as well. And then also, for whatever reason, professional market sentiment people talk about the crude gold ratio, put call ratios on gold. All I see is bullish comments, which makes me feel warm and fuzzy, to be honest with you. So the professional market seems to be in denial. They're thinking about inflation, but really the days of gold being a proper inflation hedge it's almost decades ago, to be honest with you. And you've got to get wage inflation. It's not necessarily commodity inflation that gets things going. And in the long term, I just don't see wage inflation. I mean, we've got computers and robots and automation, and real wages peaked in the 1970s. They've been going down ever since. So I think some of the arguments that are there just don't hold up. So technically it was poor. Fundamentally, there's some reasons to think that it can happen. So I think there's another $100 on the downside, and it's pretty easy to know where you're wrong. You know,
Absolutely.
close back above, if you close back above 12, I think 1209 is a level. Then you say it's a false break. So it's easy to know where you're wrong, and it's not very far away.
And then in the email that we sent out to you guys today, we did mention that we'd run a few levels past you. Well, that's one of them. We think we're wrong. If the market goes over 1210, we think support's down at 1060, which is the orange lines at the bottom that I'm just highlighting with my mouse cursor now. We think that there's lots of support there. But we also importantly know that we're wrong if the market was to retrace above 1209. And I might just go back to, I know we touched on, last week we touched on Dust, which is like an inverse gold ETF, and it's quite leveraged, but so the product we're looking at now is called Dust. It has an inverse relation to gold, so when gold goes down, it goes up, but at 3 times the pace. It's trapped in a nice little well-behaved channel here. Certainly there's room above that channel for it to move a little bit higher. So we're watching that one at the minute. So that's gold.
Certainly on the technician, when you look at the time areas and the resistances, then that also shows that there's a lot of room there.
If we go back to Dust here on technician. Technician guys, everyone, it's a free program. It's pretty awesome. Our software sort of is within technician, but the actual underlying program that you're looking at now is free of charge. It's one of the best packages out there. Okay, so here we go. You can see just how far this market Dust has moved on the downside and looks to be pushing up in the short term. Sorry, let me just adjust this for you. Okay. In fact, we had a little buy signal there yesterday. So at the moment,
the other thing there is just look how far away those annual levels are.
Yeah. So what Sean's talking about, for everyone that's watching, if you look at my mouse at the bottom study, we're down here at where it says 39. Really, the next level up on an annual basis is up to 550, basically right up here. So there's a lot of space up here. And one thing that I do know is that when markets move into space, they generally fall. So we're watching this one. We've mentioned it for a couple of weeks now. We're watching this one for a breakout, and everything is saying that gold is not finished on the downside yet. And for all the bulls out there, I'm happy to go your way, but it's got to get over 1210 first. So until then, I'm bearish. I guess next, Sean, we'll have a look at the dollar index. That's been a huge driver for the last year basically, and more importantly now as well, because it's broken out above above the highs, and in fact it closed the month above the highs. So to us, that's a bullish signal again. I did want to point out one of our studies on Chart IQ that possibly for most new subscribers, they probably haven't spent a lot of time looking at but it's a very, very, very valuable study, and it's called range deviation pivots. And you come into the trade safely drop down. It's identified here, range deviation pivots. You can specify in daily time frame, weekly time frame, monthly time frame. At the moment, we've got the study specified on a monthly time frame, and so even though we're on a daily chart of the dollar index, we can see these 3 levels above price and 3 levels below price. But what's interesting about these monthly range deviation pivots is that if we go back to the low in May this year, every time the market has pulled back in this uptrend, it's come back to the first range deviation pivot on the downside. So it's this brown line here. So if you just follow what price has done through the whole rally since the low, it's held the first range deviation pivot down. It bounced off it here. It bounced off it here. It had a spike low into it here. And now again, just during the week, we've come through, we've tested this first range deviation pivot down, we've held, and the market's now taking off again. So for the subscribers out there, it's well worth you opening up the trading safely drop down, adding range deviation pivots, and spend a bit of time having a look at the relationship of that study to price. And we're happy to take your questions going forward there. But what I made the point to one of our subscribers this week that typically when you're in an uptrend, when the market pulls back down into these first pivots down, the brown one, that's typically a buying zone. And on the monthly level, it seems to have held. So to me, that reiterates the fact that the dollar index is bullish. It does have a little bit of work to do now. It's got to get through this high, and it's going to be an interesting week if it breaks through that. We've got the euro at the low and the dollar index at the high. So potentially the market could be fairly explosive one way or the other here. And everything's saying that the tendency is down, but let's just wait and see what happens this week. But the bias is the upside for me. What about you, Sean?
Yeah, I'm very bullish on the dollar. Won't go into the fundamental reasons, but there's a lot of them. And it's technically the thing about the falls is they're very, very short-lived. That spike low in November was on the Trump election, so we didn't spend more than a couple of hours down there. And then even this week, we dropped very sharply, I think, on Monday. That was which was more to do with the euro. The euro really squeezed everybody out. They were to do with the Italian elections. They all said if it was a no vote, then the euro would collapse. And of course, everyone was already positioned for that because that's what the polls said was going to happen. So the result came out, and the euro went through the roof. But by Thursday, Super Mario Draghi managed to completely undermine the euro again by adding to the madness of quantitative easing. Also said that he wasn't going to bail out an Italian bank that's bankrupt. And so the euro reversed very quickly, and you've seen the dollar index go back up. So there's potentially a lot of differentials in terms of interest rates. You've got interest rates potentially going up in America, where interest rates are not really going anywhere in Europe, and the differentials are starting to become something where it becomes a bit of a self-fulfilling prophecy. And so I'm pretty bullish on it. So I've got March and June options next year on the dollar index, which I've had for quite a while now, and don't see any reason to see that change in trend. We've really got to it's got to close on a weekly basis below 99.50 before I'd say that the major trend was no longer up. That's a fair way away.
Yeah, so that's a couple of levels there. On the downside, we've got that support, I think, all the way through from 99. But then on the upside now, if we look at this this break line up here from this low before the final low, that's targeting. It's telling us that the next target in time is probably going to be around right here, which is around 108, something like that, 107, 108. And that's going to coincide with the breakdown in the euro. So that euro has been in a sideways pattern for more than a year. you know, if I was to flick over to it now, is the monthly chart of the euro. Okay, this is giving you the big picture. I know before I touched on the angles of a chart, well, we can see the angles here. At the moment, all the angles are down. The euro's in trouble. The dollar index breaks higher now, and the euro takes out these lows. It can fall pretty quickly down here to 95 cents. And then we'll just leave it at that for now. But it's not a pretty picture for the euro, especially in light of what's going on with Britain and now Italy and the general European. I'm not sure how you describe it, but it's not good.
Malaise, I think we call it malaise and be polite.
Yeah, indeed. Yep. So watch for the break this week, guys, of that that low at 104.63. 95 cents is heading your way at some stage. And look, if it doesn't, maybe Yellen doesn't pull the trigger on rates and we have another little bounce. It just seems like it's going to be more of the same old stuff that we've had this year. Sideways, just waiting for another reason to go down. So may bounce, may continue to go sideways for a bit. But longer term, the angles are staring you in the face. They're down. So the levels there on the euro, probably around that below, really, Sean, don't you think? 104 and under there.
Yeah, it was 104.50, and then after that, there really isn't anything. I mean, when you look on the left-hand side of the chart, we all used to call the euro the toilet currency because it had basically gone down the U-bend and was going down the other side. And looks like it's going to go all the way back to where it started. Seems difficult to think anything else, really.
Yeah.
You know, we've got elections next year as well, so France and Germany. So.
The
rallies are always squeezes, a short covering. You know, they're very swift and violent, and then the dominant trend sort of reasserts itself. You know, the rallies when they come are very swift, but they don't last very long generally.
And I guess the other thing too is like with a collapsing currency, collapsing confidence, you've got to wonder where all the money in Europe is going. And I'm going to just switch over to the DAX now, which is the German index, and that's going to give you a little bit of an idea. Okay, so the DAX this week has just popped into a bit of space, and it has now got permission to move up pretty violently by the look of it to me. You know, perhaps the back test.
Yeah, it was a major breakout, and there was a daily buy on Monday. So what I call a buy as a continuation. So the trend was up. It was a time continuation signal, and it's broken up. So that's got lots of room to rally.
Yeah, and certainly a pullback to this trend line around 11,000 would seemingly be a great opportunity to buy. And it's got space right up through to these resistances up here, which are a long, long way away. So I think that's where some of the money's going. And obviously the other one is the Dow. And for all our subscribers out there, we're giving you the background as to where we think money is going around the world. And here's the Dow. If we go back to the bottom of this trend line, that's back to 2009. The 2009 low, the angle of the line gives you the angle of attack going forward. And look, last week, we projected this angle off this high here in November, and we've now closed above it. There's nothing stopping this going high now to have a look at, 21,000. The market's breaking out. So extremely bullish, the Dow, and it's interesting to read through the news. Everyone's, it seems like a lot of people are bearish, and yet the market just keeps going higher. Sean, what do you reckon?
Well, I think a lot of people, the real issue there is if you can look at a chart of, say, the S&P 500, which was trading 24 hours a day, and it looks like there was a giant buying opportunity on the day of Trump. Well, actually, on the cash market, by the time the cash market opened, it was pretty much unchanged from the day before. So there wasn't a lot of opportunity, and there was a huge number of buy signals the day after on individual stocks. And it just seems to me that price moves so violently, so quickly, that a lot of people didn't get involved. There's also an element of the time of year. If you're a hedge fund or in a big bank or whatever, especially in America, your end of year is really November, it's not December. And so there's a reticence to get involved in new positions in December. And I think a lot of people miss the boat. They're going to underperform again, the hedge funds. And I think it was Monday or Tuesday when we just took off all of a sudden. I think it was just an element of people thinking, I'm just missing the boat here. It's already sailed, and I've got to get on board. I've got to get something. The S&P went up all 5 days last week, which is, it's unusual to just keep on going in one direction. Also got to remember markets are a bit thinner this time of year, and also there's a traditional Christmas rally the market always seems to latch onto, and generally market makers quite often just mark stock up. They don't want to take new positions, and so they try and discourage buying by elevating their offers, and so this all feeds on itself to a certain extent. So yes, it's bullish. Need the Nasdaq to join the party, as it were, because a lot of tech stocks are still below. But there's something just I put out on sectors. The people who subscribe know that I do a lot of work on sector rotation, what's fashionable, what's unfashionable, and I went through everything yesterday just to review the top 15 sectors and the bottom 15, of which there's 197 sectors overall. And what stood out was that even the bottom sectors, of which, if you go into Technician and call up ODP, this is one that they've been watching, is that all the sectors are going up. So even the weakest sectors, sector number 195, when you actually look at the components of what's in it, it's still, they're still going up. They're just not going up as much as some of the others. In fact, the only real things that went down last week were precious metals. So mining stocks were poor. And then also one of the leaders, which was defense, which was straight after Trump. They also underperformed, which is probably more to do with profit taking than anything else. Now, ODP, Office Depot, something, I can't remember what they called, office furniture, been 197th out of 197. Been a pretty terrible stock. That rally, you see that green square in November. Sorry, that was in October, yeah, the first one. That was on their results. They actually missed by a long way. So you've got bad news, good action. And if you look at the time area below, you can see that everything's gone underneath, and it opened up a lot of space. And the initial target was pretty much $5 and $5.24. And it got there very quickly. So an unloved stock has pretty much rallied 30% plus in a few weeks, which shows that idea of what is unfashionable becoming fashionable. As a sector, it's still very low. I mean, I think it's about 175, but it's gone from 197. And if you call up LMT, which is Lockheed Martin, this was one that really took off after Trump. There'd been a buy signal before that we've mentioned in previous weeks, and it reached its first upside target, and there was a sell signal on the trade safely, I think on Monday, and then on Thursday really underperformed. So there was some rotation going out there. So everyone was very heavily into defense, and now they've all headed for the exit and taken their money. So that sector rotation or pass the parcel is a critical point that everyone needs to understand. What is fashionable, what is unfashionable. While we're on that, if you call up POT, this is one that subscribers got involved with the week before, and I wrote a piece. This is one that I've been watching for the last year or so, and it's a fertilizer stock, biggest fertilizer stock in the world, I think. So linked to grain prices to a certain extent. The interesting thing that's happened here has been going sideways all year, very, very quiet, and then finally broke out last week and you can see there that the yearly levels on the study below are down at the next levels at 27, then 37. We're currently trading at 19 3/4. The subscribers got involved the week before, so you can see there's that time continuation signal, that little triangle, diamond, that was going into resistance. Now, the thing that I said was that because the market's been going sideways for a year, option premiums were very, very cheap from a mathematical point of view. And there's a thing called leaps, which are long-term options. So effectively what I did was I got involved in the $20 calls for January 2018. So I was buying like a 14-month option, and a $20 option cost $1.50. So you trade 100 shares at a time for each contract you trade. So you're spending $150 per 100 shares, which is for over a year is not very much. And you could obviously, depending on your situation, you could buy as many contracts as you want. And now that we've broken up, there's lots and lots of space. So to me, that was a classic example of something that's been unloved. It's going sideways, and now is breaking up. So if it comes back down to where that breakout point is, that's a major support point. I'd be probably looking to add to that position.
Yep, reminds me of Origin Energy, actually, this whole distribution of price. If I pull it up, it's almost a replay. It's been the whole year, it's been spent in sideways. It's an Australian stock, tightly related to the oil and gas sector. It's actually effectively a call option on the oil play, but it's displaying the same properties. It's spent the last year going sideways, trapped, and now potentially making new highs. So we're very interested in that stock.
Did you see the news? Did you see the news today? The non-OPEC agreed a cut of 550,000 barrels a day.
Is that right? So
yeah, I think
oil's
I don't know why I shouldn't really be reading financial news at 7 o'clock on a Sunday morning. Really, I should get a life. But
well, if we go back to oil and just let's have a look at oil then, because it's right at the popping point. Okay, so here we are. This red line, all these different colors you're seeing, the blue and red lines, they reflect different time frames. So the red line is a monthly time frame, and so it signifies the importance of that high. And we've had one crack at the top, one and two cracks at the top, and now a third. So guys, if we take out this high here at 52, whatever it is, 57, something like that, on the third pop, I think you can say it's fair that it's heading straight up to 60 odd bucks. So pay attention for oil making a new high above 52.5. That's going to be an interesting development.
Sorry, just on technician, can you call up XOP?
Yeah, so XOP
that's a oil and gas exploration ETF. So a way of having a broad exposure to oil, and yeah, doesn't surprise me. That's broken up. So that's actually leading. So the stocks are actually almost leading the actual oil price.
We're well above the midpoint now, and there's a gap up here to 56 bucks. That's from 42 to 56.
Yeah, so that looks pretty positive already.
So look for new highs in oil and breakout in oil stocks potentially.
Just the final thing on signals that came up during the week. First one in UK stocks for a while, which was DGE, Diageo.
For the new subscribers, by the way, we do have a system that we haven't shown you tonight. It's in the trading safely drop down at the bottom here, trade safely. What it does is it gives you precise buy and sell levels, and it tells you where to take profit, and it tells you stop losses.
Actually, you can put that on for this one because there's been a few signals on it.
For XOP?
No, for DG.
DG.
Do trade safely and then just do DGE.XLON. There we go. So this was a trade Gilby, I think, got involved in as one of our apprentices back in September. So there was a sell there, got very close to being stopped out at the highs of the year, and then it's come all the way back down since, and it's been a few signals in that sideways rotation over the last month or so. So buy, sell, and another buy, and that buy has now got very close to its first target. Closes above 2050, I think it is. Then there's a little bit of noise above a monthly level on that time area study below, but then it suggests that there's space to go all the way back up to the top again, which is 2280, I think, something like that. So that was one that people got involved in this week.
Back in Australia, we had, I think we had ASX.XASX. You know, there's a couple of recommendations that went out this week. They didn't do that well. They were right at resistance. So, and that's the good thing. I mean, you know, we haven't been stopped out of this trade. We've got the sell signal there, the blue arrow. We had one profit taking point, which is the green number one. I mean, the stop's up here. So this trade's still valid. We're running with that one. Another recommendation was the Commonwealth Bank. All year it's been in a sideways range. We had a sell on it, just by virtue of the fact that it, you know, all year it's been testing support and resistance. You can see here, buy at support, sell at resistance, buy at support, sell at resistance, buy at support, sell at resistance. And look, you know, we're pretty much out of this trade, although you'll notice right here, the pink line, that's our final protection line, and that candle, it actually still closed under it. So we're actually still in that trade. But you know, potentially the Commonwealth Bank could be breaking a lot higher if we do move higher here. And the reason I say that is because for months and months and months and months here, we've been oscillating in a very tight range. And the best way to think about it is like grabbing a can of Coke and shaking it as hard as you can, and then opening the lid. So when you take out a level that's been in a range for an extremely long time, it's going to fizz everywhere. And so right now it might be up, but as far as we're concerned, it hasn't closed over that level yet. So we're still good on the short CBA, but be pretty quick to turn that one around.
There's one other, GPN in America, N for no.
GPM?
No, N for no, GPN. Similar situation to, well, not exactly so, well, you can see there was a sell on GPN a few weeks ago, came down, had a number one appear, so partial profit.
There's a sell signal here, and then buy part of it back here.
Yep, and then gone back up, and then gone down again, and now it's moving up with the market. So that's an example where the stop loss is relatively tight. You can see we're at 74. So tracking the market at the moment. You know, it's difficult to find stocks that are actually going down at the moment. There's not very many of them, that's for sure. It's the precious metals.
Yeah, just flicking back to bonds, because I know we mentioned bonds in an email that went out to everyone. So let's quickly flick back to US 30-year bonds. We touched on this last week. So this is a chart, a weekly chart of US 30-year Treasury bonds, and I want you to look at the yellow lines. That's the channel that we've been in since 2011, and that little white rectangle is the break of that channel. That happened not that long ago, and I can't emphasize how important this breakdown is in the bond market, because I keep saying it each week, but the amount of money in the bond market is 3 times the size of the global equity market. It needs to find a home because it's made a high. So right now we've come back to support, which is this red line you're looking at, and we've broken under it and closed under it. I think everyone's been waiting for a bounce up to 158, on the 30-year bonds to sell it, but it's just not happening. So this is what's going on, everyone. The bond market's breaking down, and the money is going into the US dollar and then into equities. So for all the bears out there, good luck being short equities, because it's the bond market that is driving the capital flows around the world at the moment. If we go back to, say, the Australian market for all our local subscribers, similar story. It's not as far advanced as the US bond market. It did break into space here. I'd say if we close under this weekly low here at 9713.50 on a weekly basis, it's heading a lot lower and pretty quickly, because as you can see, there's no impediments here. The market can just fall very, very quickly. So everything's pointing to equities up, bonds down, dollar index up, gold down, as far as I'm concerned. John, what do you reckon?
Yeah, I mean, certainly on bonds. Been short bond market since August and then added in October. The bounce has been pretty poor. There's a bit of divergence out there in the French bond market has been holding up. And also, not going to get too technical, but there's things to do with the yield curve, to do with what Draghi said. So the short end interest rates went down, so talking 5-year money and below, whereas 10-year money and 20-year money, so that's bills and buxels, those interest rates went up. So there's big shifts in the curve. And if you're going to be short bonds or short the bond market, it's definitely the longer end. So there's in the American market, something called the ultras, which is a proper 30-year. There's T-bonds, which is really a 20-year. And then in Europe, you've got the buxels, which is a 30-year as well. So at this stage, you know, the trend is definitely down. The targets are still a considerable distance away, so plenty of room.
And look, just finally, I think we're going to wrap it up pretty quickly here, but I think just going forward, you know, the Trading Safely program, we've got a lot of indicators up here, and I think it's just worthwhile explaining. Just right at the end of each week, we'll just introduce something new and tell you what it's doing, so you get a feel for the power of some of the studies that we're offering. But what we've got here is called time steps, and what it does is it tracks trends in many different time frames all at once. So if we look to this green zone here, what this is doing is telling me how many time frames are participating in an uptrend. And so when I see this green color here, that's the daily time frame. The dark green is a weekly, and this blue time frame is the monthly. So right now in the dollar index, it's telling me I've got daily, weekly, and monthly time frames on the upside all kicking in, and yet on the downside, this is telling me how many time frames are trending down. So as the market pulled back here, we could see this daily accumulation in the pink color, and the orange color is the weekly accumulation of weekly downtrends. So we're just going to keep introducing these concepts to you. It helps us get a handle on how many time frames are trending, because the more time frames you have trending in one direction, like we have right now in the dollar index, we've got a monthly trend, we've got a weekly trend, we've got a daily trend, and we've got the only downtrend was like a daily time frame. So now when you've got the daily time frame competing against monthly, weekly, and daily, you know straight away which time frame is going to win. So that's called our time steps. It's one of our cool studies, and you know, if you jump on board the offer that we're looking to put out through the week, we're offering 10 places where this is a really exciting offer, guys, because you're going to get a month for free to work with us. We'll give you the studies. You can open up a CFD account with a demo $25,000 funding, so you don't have to risk any of your money. We're going to give you one-on-one. We're going to look after you one-on-one treat you like a proper client. We're going to show you exactly what we do and work with you for a month. And so we're going to offer 10 places through the week. So make sure you check your emails this week, because we're going to put that offer out. It's going to get snapped up pretty fast, I think. But 10 places is all we can cater for, because we want to do the right thing by you guys. We want to spend the right amount of time. We don't want an infinite number of people. So just stay tuned there. So I think that's it, Sean. Are there
Yeah,
any?
I think that's it.
Are there any questions? I'm just going to flick back to Google Hangouts, see if we've got any questions. If you've got a question, I know it's hard for the people in America. You guys are watching this on replay. We're probably, going forward, we might open up a couple of sessions in the American time so we can take your questions for time. But don't forget, you can just shoot us an email anytime on www.tradingsafely.com.au, and we're more than happy to help you. We're more than happy to give you a free consultation and, just spend the time answering your questions. So that's it for me, guys. I hope you have a great week. Sean, I'll leave it with you, and then we're going to wrap up.
Okay, yeah, I think we're done. This is probably the last week where there's any sort of real volume. The following week will start, be the week before Christmas, so it's starting to get pretty thin. So the trend is your friend, there's no doubt about that, and we've said what those trends are. There's nothing at the moment that's saying that they're going to reverse in any way, shape or form. So next week is probably the last week of meaningful price action. After that, everyone's doing their Christmas parties and everything. So tune in next week and see what's come up. And to our subscribers, I'll be in touch tomorrow.
Okay, great. Thanks, guys.
Okay, thanks everyone.